Hello, Matthew Bell with InsurancePrescription.com, and today I just thought I would tackle a question that I was recently presented with and had to puzzle through to find the answer myself, and that is, why is it the case that savings accounts, money market accounts are limited to no more than 6 electronic fund transfers or 6 transactions per billing cycle, so that usually amounts to per month? So why are those limitations in force? I had to figure it out, and I thought I would share what I found with you. So firstly, it's important to understand the distinction between a transactional account and a non-transactional account. So a transactional account is basically like a checking account, an account where the expectation is that you are going to be moving money in and out of it or transacting business with it frequently. On the other hand, there are non-transactional accounts, and these are going to be things like the savings account or the money market. They might be called growth accounts or something, but the idea is, in contradistinction to a checking account, that you are not going to be conducting frequent business with those accounts, but rather you're going to put money into them and just let it sit. So a savings account and a money market may carry a higher interest rate, probably will, even if in this interest rate environment it may not be that much more, it's still going to be more than what you would get in a checking account, generally speaking. But in this context, what we mean by a transaction is generally an outgoing fund transfer, withdrawal, distribution. We mean some kind of money going out of the account. So there's no limit on how much money you can put into the account. But what we're talking about here is the limit on the money you can take out, or at least the frequency with which you can take money out. So these are going to include things like checks, debit card payments, electronic fund transfers or EFTs. There's also something called the automated clearinghouse, or an ACH. It's sometimes an ACH debit. It's a kind of a debit run through a particular network for checking to make sure that that transaction is secure. Wire transfers. These all fall under a general heading of what are called convenience transactions. Now, the relevant federal regulation is referred to as Regulation D, and it comes from the Federal Reserve Board. And it's actually a way of stating that Regulation D is actually shorthand for Section 204.2 D2. What the regulation pertains to is the bank's requirements for how much money they have to have on hand, so the bank's reserves. So there are various reserve requirements for depository institutions, including banks, credit unions, savings and loans, and the like of this. Banks are required basically to have enough cash on hand to be able to pay out any kind of expected transactions that they might face. So somebody coming in, having a checking account, there's an expectation that there's going to be business transacted, and so there may be various different levels of reserve requirement. I've seen various numbers. I'm not a banker, so I can't tell you specifically, but it looks like it's something like 3%, 10%, depending on the car, depending on the account, depending on the bank. The account might have a reserve requirement of 10%. So that means for every $100 deposited for that account, if there's a reserve requirement of $10, that would mean the bank has to have 10 of those dollars on hand. But banks calculate the actual amount they need to have on reserve on the basis of applying that 10% or whatever the reserve requirement is to the sum total of money that is deposited into transactional accounts. So they would add up all the money in the checking account, multiply by 10%, and that would be the reserve requirement, let's suppose. But there are no reserve requirements, or at least none that I could find, on non-transactional accounts. So there's no reserve requirement, or at least the requirements are relevantly different on savings accounts and money markets, those accounts that are basically classified as non-transactional. So that means, let's say, that if a bank has $200 in it, of course it would be a small bank, but if the bank has $200, 100 of which is in a checking account, and 100 which is in a savings account, the bank is required to have, let's say, a 10% reserve requirement on the checking account, but let's say it has nothing on the savings account, then that means that for those $200, the bank is required to have $10. Now, if a person is using their savings account as a checking account, then the bank ends up with a shortfall on the basis of this Regulation D. Because if a person's using their savings account as a checking account, then the bank should have $10 more according to this reserve requirement than it actually has. Now that can put the bank into a precarious situation if and when the bank is required to pay out more money than it has on hand. Then it can cause a run, essentially, where the bank has to turn to another lender in order to make up the shortfall. Now this kind of a situation, of course, my toy example is very crude, and it's also very, very small fry. But this kind of a thing where banks did not have enough money on hand to pay out all of the people who came in was one of the things that triggered the Great Depression, or one of the things that occurred during the Great Depression. There was a run on the bank where people went to the bank to withdraw their funds, and they discovered that the banks did not have their money, or at least did not have all of it on hand. Now banks, because they are required to conform to these Federal Reserve requirements, are actually subject to penalties if the banks themselves do not uphold these reserve requirements. So these are not done, I think, per day, but they're assessed on the average over a period of time. So if the bank on average over a period of time consistently comes up short in its reserves, the bank can be fined. And so if the bank is coming up short because it is allowing customers to use their savings accounts in a transactional way, but it is not covering those in terms of its reserves, then the bank is going to get into trouble, essentially. So the bank translates that over to the consumer, over to the account holder. And so it's not uncommon to find that the banks are going to enforce certain penalties on people who used savings and money market accounts as if they were checking accounts. So that might include closing the account. It might include freezing the account, or it might include reclassifying the account from a savings or money market to a checking account. But many times there are going to be fees and penalties that are associated with those kinds of drafts. You might get a message that says that you have exceeded the allowable amount of transfers, or that you have reached your transfer limit, or something similar to this, as an indication that you are now in territory where you are no longer permitted to allow any more withdrawals to come out of that particular account until the next pay cycle, or until the next billing cycle. So once again, these are requirements that are supposed to prevent people from using their non-transactional accounts like savings and money markets as transactional accounts. The penalties and fees that are paid are in part a function of the fact that the banks themselves owe penalties and fees if they do not conform to various reserve requirements, and the reserve requirements are calculated on the basis of what kind of an account it is. So if it's a transactional account, there's a particular reserve requirement, and if it's non-transactional, then that reserve requirement does not apply. Now it's interesting that these really seem to pertain only to what are called convenience transfers, as I said, so electronic transfers, checks, and the like. However, there seem to be ways of getting around the regulation, or if maybe getting around it is perhaps a little bit of too loose a way of speaking. The reality seems to be that Regulation D only polices convenience transfers. So for instance, if you go into the bank and the teller requests the transfer, then this does not seem to be spoken about in Regulation D. Now having said that, banks are permitted to be more restrictive than Regulation D. So your bank might prevent you from even going into the bank and requesting a transfer from the teller, even if Regulation D does not require that they limit that transaction or restrict it. The bank itself might choose to do so. So you really have to be aware of what the limitations are. If you think you're running afoul of this particular regulation, a call to the bank can perhaps help clarify things. You might even be able to ask a person in the bank, hey, I'm approaching 6 or more transactions, or I anticipate having to do that. What's the way that I can do that and not fall under the penalty? But another way of looking at it would be, if you find yourself consistently in that position, you might want to just reclassify those funds or move them into an account where you don't have those restrictions. If you're using a non-transactional account for transactions, it might just be better to move the money into an account that is actually classified for the kinds of money movements that you wish to make. So I hope that cleared things up just a little bit. It was actually interesting to me to find that out, and it made a little more sense of the situation. So if you found something of use, I invite you to please like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you.